Over the course of several years, China's incentive spending led the globe, surpassing that of any other country, from Washington to Tokyo. Now that state coffers are depleting due to fighting COVID and dealing with the possibility of a worldwide recession, Beijing is being forced to reevaluate that contentious stance. The world's second-largest economy is struggling due to an increase in the number of confirmed cases of the COVID virus. In addition, expensive subsidies have yielded little fruit in a market controlled by the US and its allies, and have led to many high-profile corruption probes. As a result, there has been a shift in policy, and officials are looking for new measures to aid domestic chip manufacturers. Beijing's long-term objective hasn't changed. Under Xi Jinping, the government is as determined as ever to become technologically dominant, or at least competitive, with its geopolitical competitors in the design and production of components essential to almost every gadget in the world. China may now opt to allocate its limited state funding into specific regions rather than attempt to recreate a Western-centric semiconductor supply chain. Semiconductors for electric cars, innovative materials for next-generation CPUs, and open-source chip design all fall into this category, all of which are still in their infancy and cannot be claimed by any one country. The Communist Party, in a conference presided over by Xi last September, mandated that the nation devote its resources to developing strategic technologies in which it has a competitive advantage. China needs just to be strong enough in a few critical industries. Beijing's apparent U-turn draws attention to the Herculean task ahead of China as it attempts to ascend a $550 billion industry. In 2022, Washington made its most concerted attempt to halt that advancement, and the strategy seems to be working. The COVID-19 pandemic exposed national dependency on one another for critical electronic components, fueling tech protectionism throughout the globe, and heightening the US and China's competition over semiconductors. Blacklists going back to the Trump administration have made it difficult for Chinese semiconductor businesses to acquire cutting-edge chip-making machinery and design software. They have even prevented them from securing contract chip makers abroad, but it's stuck with few options. China's capital has long recognized the importance of the industry to the country's overall safety. In the future, the nation's capacity will increase thanks to previously deployed or put-aside capital. From 2021 to 2023, the United States is projected to have the highest number of new chip facilities of any area in the world, at 20. What kind of policy backing is needed in the future is still up in the air. Officials are probably rethinking their approach. The progression of technology is not only necessary but also achievable, as seen by past achievements. Over the years, firms at the forefront of the chip industry have come and gone, depending on who made the most astute technological wagers. DRAM helped put Japanese companies on top in the 1980s, but in recent decades, both South Korean competitors, which spent more on memory chips, and Netherlands-based ASML, which focused on lithography, have beaten them. TSMC has invested heavily in cutting-edge logic circuits over the course of a decade, allowing it to surpass competitors in market value and become the world's most valuable chipmaker. The success of TSMC is founded on numerous failed situations. However, Beijing may need to adjust its established strategy to achieve the same level of success as Japan and South Korea. More than $100 billion has been set aside by the Chinese government to develop China's domestic semiconductor industry and reduce the country's reliance on Western suppliers. This country established the $48 billion National Integrated Circuit Industry Investment Fund in 2014, which has lavishly invested in leading chip manufacturers such as SMIC and Yangtze Memory Technologies year after year. This false assumption of infinite funds, however, led to frivolous spending. Some of the nation's most prominent business executives were arrested and subjected to a series of extraordinary probes into allegations of corruption in 2022. Investments in China will now have to achieve a higher standard in terms of returns, necessitating more careful consideration of where to put one's money. It's likely that RISC-V, an open-source semiconductor architecture seen as a potential rival to Britain's ARM Limited, may be such a field. Since it is relatively new and open source, Chinese authorities have openly endorsed the standard as a method to leapfrog the United States, and major companies like Alibaba Group and Huawei Technologies have announced their intention to build chips based on the standard. Silicon carbide and gallium nitride chips are two examples of China's investment in blue ocean technology, but it will be many years before these technologies reach maturity. Although the technology is still in its infancy, Beijing has jumped on it as a potential alternative to silicon. Without access to U.S. suppliers, domestic chip makers are free to investigate developments in areas often considered lower end, but no less crucial to future technologies like electric automobiles. For instance, analysts predicted that Chinese power chip companies would overtake their competitors because of China's large home market and robust domestic supply chain. Investing in homegrown talent is another policy must-have. Recently enacted U.S. sanctions, including a ban on some Americans working for Chinese chipmakers. These positions will need to be filled. Talent training is the top goal in the digital innovation drive if you look at the 20th Party Congress report. China's semiconductor industry has been driven by Chinese trained in the U.S. That option is no longer available due to the new export control rules in the United States.